Right, well, good afternoon, ladies and gentlemen. I'm going to touch a little bit deeper around issues pertaining to impairment, which Mauro just touched on, and hopefully you'll draw out of this why I think we've got an issue around the need for both strong technical standards in valuations globally, but also strong professional standards. And I talk about this from two different perspectives. One, from the perspective of an accountant, so I'm a CA, and I review fair value analysis undertaken for our audit clients. And I also, as a valuer, undertake fair value work for non-audit clients, which is subject to review by the likes of you in the audience. So I'll try to keep this to 15 minutes and leave enough time for David and also for questions at the end. So I guess in one regard, you might look at impairment testing under IFRS and think it's reasonably straightforward, recoverable amounts, higher of two measurements, fair value less cost to sell, and value in use. Sounds pretty mechanical and should be pretty straightforward. But as we know through the press, through commentary from regulators, through criticism of accountants over the last few years, it's not quite that straightforward, and some of the issues that people face in measuring those. So I'll touch on a few of these and try to bring out some analogies as we go forward. Now, fair value less cost to sell might seem, again, reasonably straightforward. Take a multiple for that's observable in a market for something, apply it to an earnings base, and you have a number and deduct some cost to dispose of that asset. But it's pretty rare in impairment testing that the valuer is going to be looking at something at an aggregate listed level. He's likely to be looking at something at a very low cash generating unit level, and it's likely that there's not going to be observable multiples traded in the public domain that he can directly look to. So he has to look for analogies. And I'll be a bit controversial with Mauro. I think that valuation is both an art and a science. Now, you want to try to apply as much of the science as you possibly can, but the art bit or the professional judgment almost always comes into play because you're essentially looking at a small component of a large listed entity, or you're looking at a private entity. And what are the issues to deal with? The first is just around the multiples themselves. So what are the listed companies that you can consider comparable, transactions available? Are there buyer-specific synergies that might be reflected in a transaction multiple that you shouldn't apply to the specific case that you're dealing with? And considering whether or not a premium should be applied in those circumstances. The other issue that I find interesting, and again, there's accounting standards on the issue of fair value that are written, but they're very vague from a valuer's perspective about how you apply them and interpret them. So there'll be issues around a discounted cash flow. Can you actually utilize that in a fair value less cost to sell analysis or test? My view and my experience is that you absolutely can. It is very common practice, but you need to adjust that for market participant versus buyer-specific issues. And those adjustments, in my view, are very, very subjective, as is the application of a discount rate specifically to that. Now, the second test, VIU, again, why I think you need standards and you need a profession developed, because value in use, I think a lot of clients initially that I dealt with when fair value testing first came in and impairment testing came into play, was that I will never fail an impairment test because, bluntly, if I fail this VIU test, I'm not doing a very good job because I'll be able to fool everyone around some of the factors that go in. I don't think that's where the market has evolved to at all. I think there's a lot more scrutiny being put onto these forecasts. So I think people are looking around, what are the best economic conditions or the best estimate of the economic conditions that are likely to exist for that entity? Are the assumptions reasonable? Are they supportable? Or are you dealing with a hockey stick type forecast? How accurate has that business been in forecasting in the past? Do they ever hit budget? Are they always falling behind? Are the cash flows pre or post financing? This is important because you're dealing with apples and apples or apples and pears. In some analysis, we often see those getting mixed up. How do you justify long-term growth rates? Can they be justified? And obviously making sure that you exclude issues pertaining to items such as future restructurings, or the one that we normally see used a lot is future but unidentified acquisitions, which obviously increase cash flow and get you through the test. So there's challenges around the interpretation of those standards and how valuers will look at the cash flow. There's also challenges around the discount rate I think this comes back to some of Morrow's analysis in terms of book value versus market value within Europe. So the standard, first of all, requires a pre-tax rate. Now, the reality as valuers is that we never use a pre-tax rate. If you look at WACC rates stated in broker reports in the public domain, those are always post-tax cash flows and post-tax discount rates. And you're trying to get analogous information from the public markets to use to substantiate and support your test, and yet you're using, again, apples and pears. So the reality is nobody, from a valuer perspective, tends to use pre-tax cash flows and pre-tax discount rates. You adjust them back to a post-tax rate and then infer what that would be from a pre-tax rate. If we move maybe a bit more to the art side of impairment testing and why I think it's important, there is a strong profession that's developed that you get consistency applied in the realm of valuation, particularly around fair value matters. So what are the issues that we would typically look at that you need to somehow adjust for and take into account? There's external sources and there's internal sources. External sources, some of them are straightforward, significant decline in market value. Clearly you should be looking at and thinking around impairment. There's technological developments, market developments that occur over time. As Mauro touched on, market cap being less than book value is typically a pretty good indicator that something might be amiss there. And an increasing interest rate environment, which we haven't had for the last 4 or 5 years, but which in the next couple of years I think will start to put a bit of pressure onto some of that impairment testing as we move forward. And then internal sources, changes in the use of an asset, obsolescence in the technology sense, planning for disposing of a business or restructuring, and then continuing declining performance of an asset when management is forecasting significant improvements every year and continuing to miss their forecasts. So the things that you really need to consider, I think, from a profession, we need to make sure that we are doing consistently across the patch is the forecast, as I say, like how do they really compare to what you've done in the past, right? Is there any support whatsoever if you're consistently missing forecasts? Does a terminal value growth rate make any sense whatsoever? You'll see, or I've seen management presentations with assumptions around 10% terminal value growth rate, and to the layman, you'd kind of have to say that would kind of mean that you're going to grow at about 6-7% above inflation forever, which is, or GDP growth rate forever, which is impossible, no matter what the industry. What's going on with your top line growth compared to the market? So we typically see an awful lot of, we're going to grow our market share at 10% a year against our competitors who are obviously not doing very much, which is typically not likely to be the outcome. Transfer pricing, pretty interesting one to deal with as well. Increasingly with things like BEPS, that's going to start to, I think, have an impact on some of the impairment testing at a CG level. And then what's driving the overall expected growth and why is that considered reasonable? I think you'll see most of these, they're all very subjective issues. As I say, it's not a mechanical process. And as you start to bring in a subjectivity, and as you're using increasingly external third-party valuers for these impairment tests, that's where, in my view, it's really important that you have both strong technical standards, the valuation standards that apply to things such as impairment testing or fair value, but also really strong professional standards such that if you are getting or accepting a piece of work from an external valuer, that you can trust that there's some level of consistency and rigor and robustness to that analysis, and that the person that is holding themselves out as a valuer actually knows what they're doing. I'll pass it back over to David now, who will wrap things up.